And everybody, it's Tim Reazor with Revere Asset Management just after 3:30 here on a Wednesday night. So very quickly, stock nerds and market lovers, before you and I begin, let me give you what we're going to do tonight. I want to talk to you about a viewer question, and she asked, how do I trade the movement in the S&Ps towards the close of the day? And that's known as the ramp. So we're going to trade the ramp a little bit, or talk to you about it at the very least, show you how I do it and give you some ideas and how you can do it. They're just ideas, because as you know, stock nerds, these videos are for your edification purposes only, but some ideas around this viewer's question. I want to talk to you about why this market won't die. It doesn't mean we won't get, anywhere between 10 and 18% pullbacks, but it won't die for one reason. I'm going to show you that. And then I want to show you this week's podcast, because it goes into why you want to own assets. Now, you can own stocks if you own stocks long term, maybe your dollar cost averaging and your favorite names, but like real estate, cryptocurrencies, collectibles, memorabilia, things that are inflating. And so, and I believe that this podcast, this one right here from September 3rd, does a very good job of laying this out and explaining it. So if you're not inclined to understand why the debasing of currencies worldwide is causing this phenomena we're in right now, I think it's a good listen, and it's something to pass along. And so hopefully it's been helpful if you have listened. Much appreciated if you have, and please pass it along, because this isn't going anywhere. I'm going to show you a chart here that gets into that. Then I've got 3 stock ideas for the rest of this week and next, and we'll take a look at those towards the end of the video. So that's the podcast. And listen, stock nerds, market lovers, questions, concerns, comments, take umbrage with anything that I'm saying. You can always reach out to me, tim@revereasset.com. And look, what makes this different is the portfolio management team, right? You have questions. The people that are responsible right here for buying, selecting, selling those stocks, you have access to them, whether you're a client or not. What makes this different than every other strip mall advisor that you've ever employed or have heard about is that we don't use their tactic of plausible deniability. We actually answer to you. You have questions, we get right back to you. You can call us 855-732-5932, or you can just shoot an email. It's really simple. Something you see on the video, some question about one of the portfolios, we're always available to you. You can talk to America's Fiduciary right here. This week's a huge week for the podcast. Going to dive into a viewer question about annuities, and that's going to be a lot of fun, because really surprising stuff, and how we've been able to help. And a lot of people have been misguided and sold horrible annuities, and I think this Friday show will be super duper enlightening. So listen, never ever fail to reach out to us. Never sit on a question. Get to us, okay? We're absolutely here to help and empower you to be a little bit better than what maybe you are today. And then listen, I prefer this. Twitter is brevity. So there's a little, I call them the IPO Club, affectionately call them the IPO Club. They take the research that we talk about on the podcast and the videos, and they run with it. It's just a group of stock nerds just like yourselves that meet on the back end of Twitter. Here, you can see I got a message in here. And we talk stocks all day. And so it's just a way to, keep your appetite whetted, get your beak wetted. In stocks, if you're not connected to a community that does so. It's very lonely trading stocks, right? And so there's a community of people just like you out there, and it's a great way to meet fellow stock nerds and market lovers. And so let's see. So let's see here. Let's go to this. So why won't this market die? It's this right here. It's this M2 money supply. And so I want to show something to you here. So here's 325.19. You can see the chart. Look at this time frame here. Here is the end of March right here. The end of March right here. And then you get this straight line up, and that is J-Powell just dumping oodles and oodles of money into the market. And you can see it's kind of had that move now. So what does that look like to you? So if I pull up, say, the S&Ps, and I get them on a weekly chart, and we go to the end of March, that looks like here. So right here is the end of March, right here. And I just want you to see graphically what an increasing money supply does to markets, okay? And so straight up, right? With some hiccups along the way, but until that changes, nothing's going to change. You're going to get your pullbacks. Don't misunderstand me, but you're not going to have an 80% drop in the market like these fearmonger newsletters. You're just not going to have, because the Fed's just not going to allow it. They're going to dump oodles and oodles of money. And so inversely, what do you think the dollar has done since 2020? So here's October, here's 2019, at the end of 2019, here's the dollar spiking, right? Here's the dollar spiking higher towards the end of March. And what is the dollar done? Yeah, it's an inverse relationship. And so you just want to understand that if the dollar is able to, and July was a tough month, right? For some equities, you can see the dollar caught a little bit of a bid there, and it peaked, and then it comes back down. August is a good month, and yeah, if the dollar doesn't get any traction higher, markets probably just grind. They just make that grind higher. A little bit of setback, grind, a little bit of setback, grind, and so I think mindset's really important here. But just know that if you do see the dollar taking off for some reason, it's a market, anything can happen. That the most likely effect is markets do in fact sell off or pull back. And so be aware, be aware, be aware, be aware. And so let's get this onto a daily chart here. And so make sure I've got this lined up daily. So yeah, I think it's important to note what's taking place in the dollar right now, that you're back above the 21, right? And so 2 closes above the 21 would indicate what? A shift in trend of the dollar. And if the dollar does go back up to these levels, look for a retest. That's the August highs of the dollar. I'd probably expect a retest of the August lows of the S&Ps. It doesn't have to be dollar for dollar, but it's an inverse relationship, okay? And so understand that and be expecting it. And so when you look here, say at the dollar, let's get S&Ps, let's get ES on a weekly time frame, and let's go to an average true range chart. And what happens when S&Ps, we're on a weekly time frame. Here's 21. Yeah, what happens when you get up into these ranges? Eventually you get these pretty good pullbacks. Second ATR, those are big pullbacks. That's 2018 that you're in. So it's 2017, 2018. You had that third ATR move, to start 2020, and then of course the pandemic. 3 ATR move. We're on a weekly chart, pull back to the mean. You kind of got close enough to the third ATR there. What would a weekly pullback look like here if you were to come back to the mean, which is here, right? Well, that's 4,300. That's just a couple hundred points, and that would be normal. I'm looking. I love weekly means. I love buying weekly means, and it's easier to find opportunity, I believe, when you get that kind of flush out and find that support at that weekly 21. So that's why I point these things out to you. Will we get it? I don't know. I know that it would be most likely coinciding with a move higher in the dollar. How about the NASDAQ? Is the NASDAQ showing us anything here? Not really. I mean, hit a high earlier, right? And so this is this week. So hit a high this week. And what would a pullback to the mean look like here? Yeah, about 14,500. So about 1,000 points lower. Can it happen? Absolutely. Would it be the end of the world? No, not even close. And so just hopefully you can keep all of this in mind as we traverse, starting, it's almost next week is options expiration. And before you know it, Bob's your uncle, it's going to be October. So as we start really getting into the fall here. So let's take a look at the last couple of days, because September has been kind of sloppy and soft here. And so when I'm looking at the NQ, I see an NQ that is broken serve on the hourly chart. And really it's just getting back here above, trying to recover this 50% retracement from its recent high to its recent low. Now, does that mean it can't go higher? No. You just want to, these are just levels, they're the roadblocks. So if you overtake, you start taking, you start trading really positively with a 6% level, I expect, go up to the 618, start taking over the 618, go up to 786. They're just the toll booths on the road. And so a lot of algorithms are written to them, and that's why they serve as little blockades until price can overtake them. So S&Ps, S&Ps really didn't get back up there. So the S&P is definitely weaker here. Does that mean we're gonna pull back now? It doesn't mean we have to go any further. I mean, if you want a little bit of, well, show me a daily chart. Where are we at? Yeah, we got the 5 trying to cross below the 8, but we really didn't come down to the 21. And there's just one note here. Just one note. So if the dollar were to spike and challenge those recent highs, down here happens to be where? The recent lows, okay? The recent lows and the weekly, and this is where the weekly mean, right around this area, the weekly mean would be. So it doesn't have to fall to that level, but just so everybody is operating on the same page of music. So, but honestly, if for some reason this money supply, it's called the M2. You can find the chart on the Fred. If this starts to dip, that I don't know why they would tighten the money supply, because it would have a whole effect on. You'd see rates. Let's see TNX. You see rates go higher, and here's the TNX right now on the daily chart. Spiked up yesterday, pulls back today. Where did it pull back to? Yeah, it just pulled back here. What, to the 5? So there's a lot going on here that, and I give it to you so you can monitor it at home, but understand that this is an uptrend until that money supply tightens, and pullbacks. Timing's everything, but maybe you consider buying pullbacks until you start seeing those signals. And I think weeklies give you, when they don't come that often, but they give you a lot of latitude to work with. So let's do this. Let's get S&Ps here. Let's get S&Ps. So I had a question come in, and we'll get us back to an hourly chart here for a minute. And I'm going to read her question right here. Tim, hope you had a great week. Can you please explain or maybe include in one of your weekend sessions this phenomena of institutional buying at the close and how we can take advantage of it? I've noticed, especially with the ES, which I watch daily, this phenomena happening day after day. It happened again today, the last 15 minutes before the close. An easy 10 points could have been had if I knew how to read the tea leaves. I feel like I should just show up and trade the last 15 minutes. What clues can we find in the direction? So this person is asking, hey, I noticed towards the end of the day, and I've got this on an hourly chart, so let's take it down to like 15 minutes. I noticed towards the end of the day, we'll go 5 minutes, it's just as fine, that on S&P futures, there's a ramp, and that ramp starts, typically she's noting between the last 15 minutes, but I'm going to tell you to start looking at the 1430 time frame. Okay, so what you want to do is you want to start looking around 1430. Okay, and then 1445 is they wait to the last minute, and that's the passive money coming in. But there's a way you can get direction here, and then I'm going to give you some trade ideas around this. So this here would be, that's a 5. It doesn't look like 5, but it's 1445 or 245 central. So yeah, let me be really clear. These are central time frames. So just if you're on the East Coast, this is 1530 or 330 and 345. Hopefully that makes sense. A couple things here. You can get direction of the potential trade higher by watching the ticks, right? And so when the ticks, and that's just $ TICK, right? We've talked about this, how to use the ticks. If the ticks at 1430 or in and around that time frame, if they were to breach up to plus 600, that's most likely going to be a positive close for markets. If they want to trade at minus 600, you might want to hold off and wait to this 1445 time frame and see how things really shape up. But there's a number of things you can do. If you are a futures trader, of course, you just go in and buy the futures based on what, you can use the ticks as like, okay, I'm getting a sense of direction. And then what could be my trigger? Well, your trigger could be like, how about a 5 coming through the 8? So my purple line here, I'll just write it down. My 5 is my purple line. My 8 is the green line, and the pink line is the 21. So if you got, say, the pink line here, the purple line coming through the green line, okay, that's a 5 through the 8 cross. And that would be good for, let's take a look here. That's good for 1409, 1413, 4 or 5 points. And look, you got to, it happens quick and you got to kind of trail up your stops. But if you're used to trading futures, this is not new territory for you. You're really looking for between 5 and 10 points. And so you're not going to, you're looking for something to do consistently. And over time, that can add up. And so how do you get a feel for direction? Look at the ticks, okay? If the ticks get up to that plus 600 or higher, it's most likely going to be a positive close. And then you're looking for a trigger on a smaller time frame. On a 5-minute chart, you can take it down even smaller, and you can get your triggers that way. Now, what if it's a Monday? What if it is a Monday, a Wednesday, or a Friday? The easy thing to do is to, if you're familiar with options, you can sell a put credit spread. By selling the put credit spread, you're not selling naked. By selling the put, because these are expiring days. And on Monday, Wednesday, Friday, S&Ps or SPX, and you want to trade SPX, not SPY. SPX is going to give you a little bit more juice in the options, and it's SPY is too cumbersome, I find. And so 10 SPY contracts or 10 SPY calls is equal to 1 SPX call. And so what you could do is you could just simply sell a put credit spread or buy a call debit spread up to another level, and then you can just go and see where the open interest is in your options chain. And all of that that might sound very confusing if you don't trade options, but if you're an options trader, what I just said makes a lot of sense. And so you can sell that expiring put credit spread right at the money. And then that's a cash settled trade. If you're trading the smaller account, it's cash settled, doesn't count against you against the day trade rule. There's just a lot of flexibility here. And so, but you got to first know direction. And so this particular question, are you holding it overnight? No, this is not to me an overnight trade, what I just described to you. This person was asking, how do I take advantage of what's known as the ramp? Well, first you got to determine, is there a chance to have a ramp? And so to just cover it again, I'm looking at the ticks. I'm starting looking at 1430, and a lot of that passive money does come in. She's 100% right around that 1445 time frame, 1450, and you can see here the market really 1445 is right in here, and you got that ramp, and then 1500 just got placid. So how do you do that? You got to be in a position to do that, and to be in a position to do that, look at the ticks. What are the ticks doing? They're starting around 1430, and then you're taking your shot. And so if you just want to risk like $100, right? $100, and then the spread might be 5 points wide. There's ways to do this where you're risking one to make 2 or 3, risking one to make 5. And you're just looking to do something consistently. It's not a home run by any means. These are singles at best. And it's a consistent way to examine the close. And the more you trade in the markets like this, I think you get a real granular feel of price movement. But just to understand that when you're trading with the S&Ps, you're trading against powerful AI computers, meaning they're just running, they're running programs that are learning every second. They're growing and they're learning every market tick. And so it's really hard to do this all day. I don't prefer to do it. I don't do it. But the last half hour of trade is absolutely something you can look at. And you can even start looking at this trade, getting a feel for it around 1230, because there's something called the 1230 ramp. And so it won't, by no means do I think this trade makes you rich. I just think it allows you to get an extra shot of espresso in your coffee when you go to Starbucks every week. So hopefully that answered the question. How can you read the tea leaves, knowing direction, and then what kind of trades could you do? So sell put credit spreads, buy call debit spreads, go to your options chain and look where the open interest is, and that's usually a gravitational point. Or I wouldn't trade. I wouldn't trade SPY. I wouldn't buy stocks. I mean, stocks might move, but trying to figure out which ones are going to move, and it's not consistent. I think the S&Ps offer you more consistency, and selling those put credit spreads give you, I believe, the greatest opportunity there. So that is the ramp. We talked about the money supply, talked about the dollar. Real quick, I want to show you GME here. And this is interesting about GME. So GME is what? Down 4 points after earnings today. And you can see the implied volatility, 243%. Expected move was 33. So the market makers, the people that sell you the calls that you buy or the puts that you buy on any equity, in this case I'm talking about GME, they're the winners because they're selling you. When it comes to these earnings trades and these inflated implied volatilities, they're the house. There's a reason why there's beautiful casinos in Las Vegas, right, or a bunch of cities now, and a lot of it has to do with because the house always wins, right? The house wins the majority of the time. And why do they win the majority of the time? They're selling you the opportunity to play. And look, this move right here, this $33 was baked into the price. Well, how do they bake that $33 in a $198 stock? Or $199 stock? How do they bake that into the price? They raise the cost of the options by raising the implied volatility because it's earnings are a binary event. And I just want to point this out to you. Look at this open interest that started the day with calls, GME to the moon. Dude, they're paying 50 cents for these things, man. That's almost 5,000 people today coming in, most likely buying these things. And you can see the numbers. And so if anything, if anything, what you're always better selling. So you can sell these calls, right, to create a spread, sell a call credit spread, sell out the money, put credit spread, and $33 is baked into that. You can go 1.5 standard deviations wide. Once you understand what you're looking at, whether it's this trade, the S&Ps and the ramp, or it's implied volatility and expected move, then it becomes probabilities. And so you're just playing the probabilities. And so this is about the expected move, the way Thinkorswim calculates it. It's about a 68% chance. So if you know the bell curve, right? That's a horrible bell curve, but right in this middle, it's about a 68% chance that the event happens in this space. Well, that's about, let's just round up, 70% chance that GME is going to stay within that $33.60 whatever cents that is. I have something blocking my view on that. 68 cents. So once you understand the probabilities there, what kind of trade can you design? And oftentimes, believe me, it's not buying calls and it's not buying puts. It's selling calls, selling puts, and in the form of spreads. So you're always, so you're not naked. You're risk defined. When you sell the spread, you're risk defined, and that's the most conservative trade. And you won't hear me ever advocate for anything differently with that, especially in these videos. So you always want to define your risk when you're selling spreads. And you want to understand how to read those tea leaves. And so with the ES chart, it's the ticks give you the sense of direction, okay? And then understand that you just measure it for a month. What is the average price movement between 1430 and 1500? And then design a trade around that. And then like for here, define your risk and take your shot. And oftentimes you'll see that you're going to keep the premium that you sell. Those call credit spreads, they work pretty well. And so, but the market makers will gladly sell you anything that is clearly, this was like the Sigma event that would have to happen for this to go from 200 to 460 is, I don't even know. It's just such, you'd probably have better odds of getting struck by lightning twice in the same exact spot, in the same exact day, 1 year apart. And it's that kind of odds. And so hopefully that puts it in perspective. Let's look at some charts of some stocks that are potentially setting up, maybe some watch list ideas. And so let's take a look at HD here, Home Depot. Looked at this space, I think, last week with you. That's a really nice chart, right? And so you got back here off the 50, you have a 5 where my cursor is, 5 coming through the 8, 5 coming through the 21, and now here you are, Bob's your uncle, trading this little range. You take it down to a 4-hour chart, you know, you've got this gap to overcome. You're right at this level of resistance, 195-minute chart. And so if you can overtake that, I would look for recent highs. What are those recent highs? Let's see. What is the all-time high? I don't know if you're going to get there, but I would most certainly look for retail. We'll call it 340. So look for potentially 340 there if you can get through this gap here. And that's a big if. And then we'll look at one more thing here. Chipotle. Man, I'll tell you what, this has been like my favorite stock for a long time. I love Chipotle, right? And so not too often you get a chance to come down. And I know it's had some trouble here, but this stock doesn't, let me just show you this on the weekly chart. It's a long-term, anyone who's listened to me talk for a long time, just understands you don't get too many really these great entries in Chipotle. And on the weekly here, yeah, it's had some pullbacks here, but this has just been a hell of a run since the pandemic. And so right here, just absorbing this massive gain. And so I really like it here. I like that it's come down with the 21. I don't know where it goes from here. It might still consolidate, but again, maybe a little bit longer term approach and some of these longer trending names that appear to have the product for the market and the pricing power for the market that we're in. So just a couple ideas to consider. Again, these videos are always just for your edification and always to make you aware of things that I'm looking at. That's it. So hopefully this helps. Look forward to seeing you on the podcast, and I'll see you at the next update.